Hi friends, today we are going to discuss about the important adjustments in final accounts. So how to make the calculations of important adjustments in final account. So what are the major adjustments that will be there in the preparation while preparing the final accounts, that is trading and profit loss account and balance sheet. We already discussed the concept of accounting, then different types of financial statement in the first video. So this is a video that will explain the important adjustments in final accounts. So let us see the concept one by one. Final account is the account which are prepared at the final stage of accounting cycle to know the profit or loss and financial position of a business concern. It is an account that is prepared to ascertain or evaluating the profit and loss position and the financial position of a business concern. So that type of account is called final accounts. So in final account, the two important statement of accounts are trading and profit and loss account and balance sheet. Two important types of accounts are trading and profit loss account and balance sheet. So first one is the trading account, second one is the profit and loss account, and the third one is balance sheet. The balance of a trading account will be transferring to profit loss account, and that is called a gross profit or a gross loss, and the balance of a profit and loss account is transferring to balance sheet, that is net profit or a net loss. And these two accounts are called income statement, and the second one, balance sheet, is called a position statement that shows the financial position of a concern for a particular period of time, which include two sides, asset side and liability side, that we have already discussed in the first video. Adjustment entries are the journal entries that converts and entries accounting records in an accrual basis of accounting. In accrual basis of accounting, we recognize income when we earned them and not when we receive the cash. Similarly, we recognize the expenses when we incur them and not when we actually pay them. So this is the nature of income and expenses in adjustment entries based on accrual system of accounting. Adjustment entries are made after preparation of a trial balance. In case when he makes an adjustment entry after preparation of trial balance, he needs to treat each of the adjustment twice while preparing trading and profit loss account and balance sheet. So if you are making the adjustment entries after preparation of trial balance, the outcome will be adjusted twice. That is, you have to show the amount in trading and profit loss account and balance sheet. In case of adjustment entries are made before preparation of trial balance, such adjustment appears in trial balance. Such adjustments appears only once in preparation of final accounts. If the adjustment entries are there in the trial balance only, so in such cases the adjustment entries are appear only once, that is either in profit and loss account or a balance sheet. Some of the principal types of transaction which requires adjustments are, I will tell you some of the important transactions which requires adjustment, and the first one is closing stock. As the closing stock is an item outside the trial balance, we need to treat it twice. It is showing outside of your trial balance, that is why you treat it twice. Thus it will appear in the trading account and also in the balance sheet. Sometimes closing stock is recorded in the books of account before preparation of a trial balance. In such case, we need to adjust the purchases of both opening and closing stock to find out the amount of closing stock. If the amount of closing stock is there, it will showing on trading account credit side as closing stock, and it will again showing on balance sheet asset side as current part of your current asset. Second one is the outstanding expenses. There are some expenses like salary, wages, rent, etc., which are incurred but remain unpaid at the end of the accounting period. And there are certain expenses incurred but not paid. They are called outstanding expenses. Such outstanding expenses related to given accounting period but are not paid. So there are some expenses will be there which is incurred at the accounting period but it is not paid. Such type of expenses are called outstanding expenses. If there is an amount of outstanding expenses, that will be added along with the concerned expenses in the debit side of your profit and loss account, and the same amount will be showing at the liability side of your balance sheet. This is the treatment of outstanding expenses. So let us see what is the treatment of prepaid expenses. Prepaid expenses are the expenses which are paid in one accounting period but the benefit are received in another accounting year. Prepaid expenses represents the expenditure that have not yet been recorded by a company as an expense but have been paid in advance. In other words, prepaid expenses are the expenditures paid in one accounting period but will not be recognized until a later accounting period. Prepaid expenses are initially recorded as assets because they are future economic benefit and are expensed at the time when the benefit are realized based on matching principle. If there is a prepaid expense situation, so that expense has to be deducted from the concerned expenses in debit side of your profit and loss account and will be showing on the asset side of a balance sheet. Let us see what will be the next adjustment item, that is called accrued income. Accrued income is an amount earned but not actually received during the accounting period or till the date of preparation of final accounts for the period concerned. Such an income received is called income earned but not received, income accrued, or income due and outstanding. So if there is some income like that, so that will be there on the credit side of your profit and loss account, and the same amount will be showing on the asset side of your balance sheet. And the next adjustment is income received in advance. Income received during a particular trading period for the work to be done in future is termed as unearned income. When income is received in advance for the work not done yet, the trader is liable is such income enough to receive is not the income for the current trading period, but the services will be rented in the next year. So this is the nature of income in cases of income received in advance. If the income received in advance, it will be deducted from the concerned income on the credit side of your profit and loss account, and the same will be showing on the liability side of your balance sheet. Let us see the next adjustment, depreciation. The monetary value of an asset decrease over time due to use, wear and tear, passage of time, obsolescence, etc. This decrease is measured as depreciation. It is a process of diminishing the value of an asset because of any of the above said reasons. So if there is a situation of depreciation, that amount of depreciation should be showing on the debit side of your profit and loss account, and it will be there deducting at asset side from the concerned asset. That is total value of asset minus the amount of depreciation charged during that particular time period. Then the next adjustment is bad debts. Bad debts is an expense that the business incurs once the repayment of a credit previously extended to the customer is estimated to be uncollectible. So in such case, bad debt is a contingency that must be accounted for by all the business who extended credit to his customers, as there is always a risk that the payment will not be received. So they are expecting a risk factor. That is why they are showing the amount of bad debts while preparing the final statement of accounts. So if there is an amount of bad debts, that amount will be showing on the debit side of your profit and loss account, and that will be the amount of bad debts will be there on the debit side, and in case of balance sheet, the amount of bad debts will be deducted from sundry debtors in balance sheet. Next one, which is something which is related to the bad debts, that is provision for discount on bad debts. So the situation of provision for discount on bad debts will be like this. At the end of the trading period, there is always a number of outstanding debtors or accounts receivable. In order to motivate the debtors to pay their debt, the trader sometimes offers attraction in the form of cash discount. As he knows from the expenses that the customers are always anxious to enjoy the benefit of a cash discount, for this purpose he will have to create provision or allowance for discount on debtors or accounts receivable. If such discounts provided, that provision for discount on debtors will be there on debit side of your profit and loss account, and that amount will be deducted from sundry debtors in balance sheet. And next step is provision for bad and doubtful debts. The provision for bad and doubtful debt is an estimated amount of bad debts that are likely to arise from the accounts receivable and have been given but not yet collected from the debtors. It is similar to the allowance for doubtful debts. If there is a situation like that, that will be there on the debit side of profit and loss account, and on the asset side of balance sheet by the way of deduction from sundry debtors after bad debts written off. So the treatment will be like this. It will be showing on the debit side of profit and loss account and deducting from sundry debtors in balance sheet after deducting the bad debts written off. And the next one, provision, old provision is given at credit side of your trial balance. If the provision is given or adjustment entry is given within trial balance, there is only one treatment is there. If such situation is there, it will be deducted from bad debts in debit side of profit and loss account, and there is no recording in balance sheet. And this is the treatment of a bad debts in profit and loss account and balance sheet. Bad debts, add further bad debts, add new provision, less old provision, add discount on debtors. And in balance sheet, sundry debtors, less further bad debts, less new provision, less discount on debtors. So in profit loss account, bad debts, add further bad debts, add new provision, less old provision, add discount on debtors. In balance sheet, sundry debtors, less further bad debts, less new provision, less discount on debtors. Let us see what will be the treatment of provision for discount on creditors. Provision for discount on creditors will be shown on the credit side of profit and loss account and on the liability side of balance sheet by the way of discount from sundry debtors. So you are showing the provision for discount on debtors on the credit side of your profit and loss account as provision for discount on creditors. Then you are deducting the same amount from sundry debtors in liability side of your balance sheet. The next treatment is interest on capital. The amount of interest charged on the capital is an indirect expenses of the business, and on the other hand, it is an income of the owner. Interest on capital has the following two effects on final accounts. It is an expense of the business, therefore it will be recorded on the debit side of profit and loss account. On the other hand, it is an income of the owner, therefore it will be added to the capital account in balance sheet. So this is a treatment of interest on capital, and interest on drawings will be there the same way. Interest on drawings are the money withdrawn by the proprietor from his capital. Just as the business allowed interest on capital, it charges interest on drawings. So drawings are the money withdrawn by the proprietor from his capital. That is, some amount that is withdrawn by the proprietor owner from the business is called drawings. So there will be some interest charging for the amount that is withdrawn by the proprietor from the business. It is a gain to the business and loss to the proprietor. So it is credited to the profit and loss account and deducted from the capital in the balance sheet. I'll show you the treatment of both these things. In case of profit and loss account, it will be the debit side, it will be showing the interest on capital, and interest on drawings on the credit side. Debit side we are showing the interest on capital, and credit side we are showing the interest on drawings. And in case of balance sheet, the treatment will be like this: capital, add interest on capital, less drawings, less interest on drawings. So this is the treatment that we are showing in the balance sheet. These are the important adjustments that we are discussing in this video, and thank you all for watching in this video. So this video is discussing about the important adjustment, final account adjustments, and thank you all for watching this video, and see you in the next video. Until then, bye, take care, and see you. Thank you all.